Artificial intelligence has fueled one of the biggest technology booms in memory: soaring valuations, massive data center spending, and a rush to build capacity in such areas as electric power. Some have estimated that well over half of our current GDP growth is coming from this AI tech boom. But as with every great technological surge, overinvestment comes first and the correction follows. The question now isn't if there will be a bust, but when and by how much. I'm Richard Vague with Tycos, and today we'll discuss what history tells us about how an AI crash could unfold. The very nature of technological revolutions is such that they routinely deliver less in the short term, call it 1 to 5 years maybe, and more in the long term, the period beyond that, than predicted. Early hype brings the building of overcapacity and unrealistic valuations. The internet revolution, which began in 1995, and the telecom fiber optic revolution of the early 2000s are two relevant examples. In the Internet 1.0 crash, the NASDAQ lost 78% of its value in 2 years. Very painful memory for many. In the fiber optic boom and bust, 4 years after that bubble burst, reportedly 90% of the fiber optic internet networks laid in the 1990s remained unused, though over the ensuing years, having been written off, it provided a cheap and useful avenue for growth. We've talked often in our videos about how stock market corrections of 10 to 20% are relatively frequent and their aftermath is often short-lived. With multi-billion-dollar data centers on too many drawing boards and AI companies borrowing against AI chips to buy even more chips, it would be unreasonable not to think there's at least some correction possible, especially since tech stock valuations are at all-time highs and the stock-related debt is as well. The question is whether that correction will be in this usual 10 to 20% range, or as high as the 78% correction in the Internet 1.0 crash. After that crash, although the NASDAQ began recovering in the winter of 2002, it took 14 years for it to attain its previous high. Let's take a closer look at that crash, since it might be a useful framing for understanding the next one. First and foremost, it was a pileup of crashes. There was the Internet 1.0 crash from March 2000, October 02, and the 9/11/2001 terrorist attack-related crash, and the Enron scandal and crash from October to December of 01, and the WorldCom crash of July 2002, which was part of the overall telecom crash, which started in 2001. The broader S&P 500 collapsed by 49% in that same period. But even with that, was still above the record levels of the late 90s, which speaks to how far ahead of itself the market had gotten. With the overall stock market crash, both short-term and long-term interest rates collapsed from 6.5% to 1.75%, and from 8.5% to 6.5% for short-term and long-term rates, respectively. And that helped significantly in the market recovery. But the key thing to note is that GDP itself, which is to say spending and income, held up fairly well, reminding us that the stock market is not the economy. Let me repeat that. The stock market is not the economy, and we have to look past the stock market to deeper economic fundamentals, such as real estate, which we've often said is the largest sector in the economy, to make an assessment of GDP trends. You will note that in this crash, nominal GDP never declined. Economists have concluded that there was a real GDP recession in 01, but we would note that real GDP, meaning nominal GDP adjusted for inflation, did not decline for 2 consecutive quarters, which is the broadly accepted definition of recession. More importantly, real GDP measured against the same quarter in the previous year never declined and was always positive. Unemployment, which had been in the 4 to 4.5% range, generally did not exceed the 5 to 6% range in this period and never exceeded 6.3%. So a calamitous stock market in 2000 through 2002 was accompanied by a mild and short-lived recession. Our view is that an AI correction will do no worse than that, and in no case will bring a deep, long-lasting plunge in GDP. The wild card, of course, as we've discussed, is tariffs, which, given the way they are being handled, could make GDP trends worse than they were in this 01-02 period. But the administration's frequent changes in tariff policy make that impossible to forecast. And, as an aside, it may be that the Supreme Court will strike down those tariffs and save us that pain. We'll visit more about that in a future video. That's it for this week. Thanks.